year there was an under provision of tax. So you understand that under provision means that previous year we recorded or booked less tax, so we have to pay it now. Got it. But sometimes they do not tell you that it was under or over provision. You have to find it yourself. And you see the trial balance and you see the tax account. And how do you find out? Now, just like Dipesh said, that under provision of tax, it has a debit balance on the trial balance. Now, right, Dipesh, this is what you said, right?
Yes, yes.
And I agree with you.
Yes.
Now, my question is that why does it appear on the debit side? Why not the credit side?
No, I have the
Tax
logic.
account is a liability. My question is, tax is a liability thing. You have not paid, so it should be a liability. If it is a liability, it should be credit. Why is it on the debit side?
Sir, because it is an expense, that is why it should be on debit side.
No, that's a liability account. That's a liability account and it has a debit balance. I mean, it should logically, if you have not paid something or you paid less, it means that you must pay that now. It is your liability and it should be a credit balance. But in the tax case, we say that under provision has a debit balance on the tax liability ledger.
So initially, sir, we do debit expenses and credit provision, and when we pay to the bank, paid in next fiscal year, so we do debit provision and credit bank. This causes debit side.
I think you are almost there. You understand? You are almost there. Fazil?
Yes, sir.
Fazil, can you listen me?
Yes, I can.
Now you please explain us this concept.
Sir, as how Dipesh said, like if it is under provision, we have to pay to the bank. So we have to debit the.
We have to pay to the bank, or we already have paid to the tax department?
If it is under provision?
Yeah, we already have paid it. No? Under provision is coming from the last year. Okay, let me share it with you on Excel. Okay, this is one question, Fazil, which you wrote on the tax. Actually, we are going to touch two things on the tax thing. Generally, there are two areas where students, they need understanding. One is this under over provisioning of tax, and second is the deferred tax treatment. And of course, there's a third one like the total tax. So I'll just very quickly, I'll start with under provision. Okay, under provisioning of tax. Can you people see the Excel file now?
Yes, sir.
Okay, so under provisioning of tax means that last year, less tax expense was booked. This is what it means. Okay, so let's suppose that we are here. This is 2019. Okay, and let me write down 31st December 2019. When you are preparing your financial statements, you prepare your income statement 31st December 2019, and you calculate your taxable profit. Now you know that you have two income statements. One is for IFRS, which is called accounting profit. One is for the tax department, which is called taxable profits. Because taxable profit and accounting profit, they differ because of some different rules for IFRS and different rules for expenses for your tax department. So you have different profits. It is a very normal thing that your IFRS profit is 1 million and your tax profit is 1.2 million. So for the tax department, you go and say my profit is 1.2 million and I have to calculate my tax liability on this. But to the shareholders, you say that profit is 1 million. Because so anyways, this is not the case here, but I just wanted to touch this point so that you understand that you have two profits, accounting and taxable. So on 31st December 2019, you prepare your taxable profit. I don't know, it is $100,000. Let's suppose that it is $100,000 and you have to pay 20% tax on that. So you calculate your tax expense for 2019 to be $20,000. This is what you estimate. When do you estimate? You estimate it on 31st of December 2019. And you are not going to pay it on 31st December. You would be paying it in March or April. Okay, so you just calculate it and you record it. You book it into your income statement. So you say debit tax expense and credit tax payable, okay, or tax liability, whatever you may call it. So tax expense 20,000 and tax liability you put 20,000. This goes to your P&L and this goes to your statement of financial position. And it happened on 31st of December 2019. Then what happens? Let's suppose that on 30th of April 2020 you pay tax. Now, after 4 months, now you already, before 30th of April, you already have published, printed, issued, authorized your financial statements. So somewhere here, let me write down here that on March 31st, financial statements were authorized and issued. So on 31st of March, we finalized the financial statements, we issued, published, printed, whatever, and we submitted it. And we included in that 20,000. We kept 30,000 in mind. But then on 30th of April 2020, we are actually paying the tax, and we pay tax as 22,000. We found out that our tax liability, and this is the tax liability for 2019, was 22,000. So now this is the case of under provisioning. So it looked like that because when we finalized the accounts, we revisited, reviewed the numbers, we found out that we have to pay 22,000, or maybe the tax department came in and they knocked the door and they told you that, guys, you don't have to pay 20,000. Your tax liability is 22,000 for some reason. And now you have to pay 22,000. What you do? And by the way, when you prepared this thing, you actually prepared your T account, and on your T account, this is your tax liability T account I'm preparing. So this is your tax liability T account, and this has an opening balance of 20,000. Okay, it was a closing balance in 2019. When you come into 2020, it becomes the opening balance here. So here it becomes the opening balance. You call it balance brought down. Okay, you have on the credit side $20,000. Now you are paying 22. When you pay 22, you say debit tax, because you have to decrease your liability. You are paying off liability, so debit tax payable, and you say credit cash, or you say credit bank, whatever. And how much you are paying? You are paying 22,000. And when you pay 22,000, it comes here 22,000, and you write down here cash. Now, when the year ends, after what happens? After comes 31st December 2020. Now, end of the year comes, you go and you close your ledger. And you know that when you have to close the ledger, you will write down the bigger amount on the both sides, 22,000 here and 22,000 here. And this is 2,000, which is your balance carried forward. And then when you prepare the next year, now this is on 31st of December 2020. Now, when you will go to next period, which is 01/01/2021, in this year, when you will make your ledger account for tax for this tax payable, what you will have, this number will come on the opposite side. Okay, this number will move here. This is actually a debit balance. If you remember from our ACCF3 course, we said that if the closing balance appears on the debit side, on the credit side, it is actually a debit balance. We learned this thing in the ledgers in ACCF3. If the closing balance appears on the credit side, it is actually a debit balance, and that is why in the next period it moves in the opposite direction. If the closing balance appears on the debit side, then you call it a credit balance and it moves on the opposite side. Okay, so this is what we already know. Now you would say opening balance brought down. Okay, and you will call it $2,000 here. And that's how your under provisioning actually resulted into a debit balance. So when you said that in 2021, the trial balance when you will make, you would say, oh, that is $2,000 here on the credit side. This is the balance. Now this balance, when you will prepare because this was 2019 tax, when you will prepare your 2020 financial statements, this is 31st December 2020. You can see that there is a closing balance of 2,000, which appears on the credit side, but this actually is a debit balance. Why do I call it a debit balance? Because this balance carried forward amount I wrote down. This amount did not exist here. This tax ledger, it had a debit balance of 22 and a credit balance of 20. What it had? It had debit 22,000 and it had credit 20,000. And when you will make a sum total, the result would be debit 2,000. Okay, so this is under provisioning, debit 2,000. We call it here, balance carried forward, $2,000 debit. This I can just remove. I don't need this thing. So this is the reason that sometimes students, they get confused that if I have an under provisioning, now that is an example of under provisioning, and because you created less liability, but then you paid more liability. I mean, you credited the liability with 20K, but then when you paid more, so you debited it with 22, and therefore the debit amount becomes bigger, and it becomes an under provisioning having a debit balance. Are we clear on this thing?
Yes, sir.
Fazil?
Yes, sir.
Was this your question on the WhatsApp group?
Yes, sir.
Is it answered?
Yes, sir.
You will watch the video once more, okay?
Okay.
Now, my second question, under provisioning, what does it do? Under provisioning of tax from last year. What does it do? Increase the tax expense in the current year or decrease the tax expense? What does it do?
Tax expense.
Sorry?
Increase the tax expense.
Under provisioning will increase the current year tax. Am I right? Is this statement true or false? Under provisioning of tax from last year, the impact is that it will increase the current year tax. Is it true or false?
True, sir.
Huh?
True.
True. Okay. And over provisioning is exactly the opposite thing. Okay, this is done. Now, let me ask somebody else here. Who else is here with us? So we have Dipesh, Mushtaq, Fazil, Annie, Madiha, and Mehran. Okay, I'll start with Mehran now. So we say that how do we calculate our tax expense? Okay, so you remember that your tax expense for the year, and generally you use the word tax expense for the year. Okay, so tax expense for the year is always equal to current year tax provision, or you call it current year tax expense, whatever, and then you say plus minus Okay, plus minus last year under or over provisioning. Okay, let me write down like this, more clear. If you have under provision, you will say plus under provision of last year tax. So because you under provision last year, which means that you included less tax in last year, just like what we were discussing above here, 2000. So you have to add it. If it had been over provision, you would have subtracted. So minus over provision or plus under provision. So this year, my tax expense, let's suppose, is $30,000. So that I will write down. Then $2,000 I recorded less in last year. If you note down, in last year we said $2,000 tax expense. So it means that we recorded tax expense less because we recorded 20,000, but actually we paid 22. So 2,000 we recorded less. It was under provision. That 2,000 should be recorded now. So it makes sense. Last year I recorded less. Let's record it now. So current year tax plus the adjustment for the previous year under over provisioning, and then you say plus minus the changes or the movement in deferred tax. Movement in deferred tax. Now, movement in deferred tax means that let's suppose that last year your deferred tax balance was, say, $50,000. This year your deferred tax balance is 65,000. So you can say that your deferred tax liability. Now, I'm going to discuss deferred tax separately. You already have discussed it. There are 3 videos on that. We understand what is deferred tax. So deferred tax liability has increased from 50 to 65. So that 15,000 should be added. Okay. So this 50,000, if deferred tax increases, it should also be added. But you should pay attention. Less deferred tax on revaluation of PPE. In some questions in your ACCF 7, you would see that they will tell you there's a special situation they create that this year deferred tax, which you have 65K, within that, I would say that within this 15K, 4K of deferred tax is due to PPE. So whatever do you see the difference in whatever you see the deferred tax, this 15K, it has increased. Within that 15K increase, 4,000 is due to PPE. Now, revaluation of your property, plant and equipment, revaluation of some property. And you know that it is unrealized because that you have not sold it. That property is still be with you. Today, its value goes up. So deferred tax liability, we know that when you do revaluation of your non-current asset, it means that there is a gain. And because of that gain, a new tax liability will be calculated. So whenever property value increases, deferred tax liability increases. But at the same time, we also know that it is increasing today. It might be decreased tomorrow. It might decrease tomorrow. And besides, I'm not going to sell the property, and therefore I don't have to pay the tax this year. The property remains with me, and I cannot consider it as a tax expense of the year. We are considering here what is the deferred tax expense for the year. So whatever happened on this thing, what you call property, this does not relate to the current year because asset is not only for 1 year. So you should subtract that thing. And what you come up with your tax expense for the year now is, let's suppose it is 43,000. So this year current tax plus last year under provisioning plus the deferred tax movement if it has increased, and minus the deferred tax due on the revaluation of property. Are we clear until here?
Yes, sir.
Yes, sir.
Great. Now we are moving to the third section. So tax liability, if you think like, one, you have to show your deferred tax liability, which will be 65,000 total, and you don't take the difference. Difference only goes to P&L, but when it goes to balance sheet, if I speak about deferred tax liability, the total deferred tax liability, which will go to statement of financial position, will be 65K. And if I ask you how much is current tax liability, so of course in current tax, these 2 things do not come. Current tax, we only speak about this 30 and this 2, but this 2 we already have paid. 2,000 is just an adjustment as an increase in the P&L expense. But in the balance sheet, this 2,000 will not appear because it has already been paid. So in P&L, you have $30,000 as current tax liability. And this current tax liability, 30,000, which comes into your P&L, it is your current year provision. And always remember that last year under over provision, I'm repeating, last year under over provision does not impact current year provisioning. So current year provisioning has no impact with last year. So even if I under provision 2,000, my current year is 30,000, that remains 30,000. It is only that in P&L, it will be impacted. In P&L, I just added it. In balance sheet, I will not add because I already have paid. If I ask you what goes into the balance sheet, you will say 30. If I say what goes to P&L for current tax, then you will say 30 plus 2 plus 15 minus 4, whatever. Clear?
Clear, sir.
Okay.
Sir,
Yes.
but in one of the questions in BPP,
Uh-huh.
it asked show the tax liability for in a statement of financial position. And in that question, we took under provision, movement in deferred tax and everything.
If it had not been paid.
Okay.
In my case, I said that we paid it. I paid it. In that BPP question, you should pay attention to the language. Was it paid or not? If it had not been paid, then you still have to pay 2,000. But if it was, usually it is already paid, so it is not added. Because you prepared this thing on the last day of the year. Before that, you already had paid the taxes. Because you make it end of 2020. But during 2020, you already have settled your liability. You already have paid 22. So that 2,000 is no more a liability. I have paid it. Clear?
Clear, sir.
Okay. Mushtaq, Mehran, any question you want to ask from here?
No, sir.
Yes, sir. I
Yes, please ask.
have. Sir, here we can see that the debit side of 2000 is the above.
Sorry?
If there are 2000 of debit side, what would be the double entry for it? Like
That
we
is
will
what
complete in the.
I just
double
made this double entry for here. This is the provision thing. This is the first
Yeah,
double
we
entry you
paid.
made.
Yeah.
And this is the second you made. And as a result, this 2000 appears. 2000 is not through a double entry. 2000 is a balancing figure.
Okay, sir.
2000 was not a double entry. 2000 was my closing balance, which I calculated.
Okay, sir.
Fazil,
Yes,
can
sir.
you explain what is taxable temporary differences?
Taxable temporary differences. They are same as permanent.
I'm saying taxable temporary differences.
Okay, taxable temporary.
Remember, permanent differences are not the scope of deferred tax. Deferred tax only comes from temporary differences. Temporary differences means that there is a difference in approach, there is a difference in accounting treatment in this year, and in the next periods, in the next years, it will be cancelled out. So for example, I write down depreciation 100 in this year, tax department says they will write down 50 in this year. So there is a difference. I'm writing down depreciation 100, they are writing down 50. And as a result, profit will be different, and as a result, profit tax will be different. So that is a difference, but we call it a temporary difference, because if I write down depreciation 100 in this year, tax department says I will write down 50 this year, but next year I will write down 50 and they will write down 100, let's suppose. So total for me is 150, for them is 150. So there is a difference in this year, but that difference will be cancelled out in the next period. We call it temporary difference. And this is the cause for deferred tax. Deferred tax does not come from permanent differences. Permanent differences means that I'm writing down one expense, which is entertainment expense 1000. Tax department does not write it down as an expense. So for me, it is an expense, and tax department does not write it down. And they will not write it down next year as well. And they will not write it down ever, ever, ever. So it is only, it appears in my books. It will never appear in their books. That is permanent difference. And permanent differences, we are not speaking, because permanent differences do not give rise to deferred tax. Deferred tax comes from temporary differences. There are two types of temporary. And they are called deductible temporary differences. Who can tell me what is deductible and what is taxable? I think I explained this terminology. Yes or no in the lecture?
Yes, sir.
Taxable temporary differences, they give rise to deferred tax liability. And deductible temporary differences, they will give rise to deferred tax asset. Okay? Remember,
Okay,
taxable
sir.
temporary differences will create deferred tax liability, and deductible temporary differences will create deferred tax asset. You have both things: deferred tax liabilities, deferred tax asset. And during the year, you might have deferred tax liability 10,000. You have deferred tax assets, I don't know, 6,000. And then the difference between two is 4,000. So you have got a deferred tax liability, which is a net amount of 4,000. This goes into your statement of financial position. So it is not that you always have deferred tax liabilities. You also have deferred tax assets. And assets liability you net off and you come to a total number, deferred tax liability for in this case, for example. Now, my question is just a very quick question. I just want to wind up this tax thing. We want to move to leases. Few more questions. So I said that taxable temporary difference will give rise to deferred tax liability. Now, when does this happen? For example, we have two things. We call it your net book value, and you have your asset base. Let's suppose there is an asset, there is a PPE, or there is an asset which has the balance sheet. There is an asset which has net book value. Net book value means my IFRS thing. My balance sheet value, net book value is 100,000, or let me call it 10,000. And then I have my asset base, or I call it my tax base of the asset, which is for the tax purposes. This is 8,000. What is it going to make? Now, there is a difference of 2,000. If you see that, you would say that, because in some questions they would say that there is a difference, of 2,000 between the net book value and the tax base of the asset. The net book value is 2,000 more than the tax base. So this will result in what? Is it going to result in deferred tax liability or deferred tax asset? Need answer from you people.
Sir,
Deferred
can I
tax
answer?
asset.
Yes, Fazil, you will start.
Sir, in IFRS books, the asset has more value. So if it is having more value, then more depreciation, then it will result in more profits, then it will have less tax. Sorry, more tax.
More depreciation means?
More depreciation means less profits.
Less profit. Less profit means?
Less tax. So it will have a liability.
Perfect. It will have a deferred tax liability. Some of you people can just remember it by heart, that if your balance sheet value and net book value is more, it will give rise to deferred tax liability. Otherwise, if you want to learn the logic, you can say that when net book value is more, it means that depreciation is more. And if depreciation is more, it means that profit is less. And if profit is less, it means that less tax will be paid. Less tax will be paid now. So if you are paying less tax now, ultimately you will have to pay it in future. So it means it's a liability. So is this an example of taxable temporary difference? This 2000, or is it an example of deductible temporary difference? This scenario will
Taxable.
give rise to what?
Taxable
Taxable temporary
Taxable
difference.
temporary difference. And if I tell you that your tax rate is 30%, so how much is going to be the deferred tax impact of this one asset?
600 is
2000 into
Into
0.3,
30.
600. So you are going to get a taxable temporary difference of 600 due to this transaction. Okay, if you want to write it down more, how to say in the accounting language, I would say that this one transaction is going to have $600 taxable temporary difference, which means that $600 deferred tax liability will be. So it is going to be a deferred tax liability or temporary difference. Okay, taxable temporary difference. Are we clear on that?
Yes, sir. Clear.
Okay.
Yes,
Any further question you want to ask?